You've landed in Canada, unpacked the boxes, and started tackling the paperwork. Then the first bill arrives, a quote for auto insurance. It's $5,000 a year, simply because the system classifies you as a novice driver. That initial premium shock triggers an immediate defense mechanism. It's easy to look at those numbers and assume every insurance product in this country is a scam, designed to drain your savings. Back in your home country, you probably didn't need formal contracts to handle risk. If someone got sick or lost a job, the extended family stepped in, or community networks provided a safety net. But the Canadian economy operates on strict private contracts. Here, an informal support network cannot cover a $50,000 medical bill, and it certainly cannot replace a lost six-figure salary. If you spend all your energy fighting short-term annoyances, like high car insurance, while ignoring private contractual protections, a single serious emergency can wipe out everything you came here to build. There is a dangerous assumption that moving to Canada means the government will catch you if you fall. You get an OHIP card and a monthly child benefit, and it feels like you're completely covered. We call this default vulnerability. It's the passive reliance on public systems that leaves families exposed to massive out-of-pocket costs and, in extreme cases, the loss of their immigration status. To protect your family, you have to redirect your mental energy. This quadrant chart maps the hurdles newcomers face: effort versus generational impact. Notice the bottom right. Fighting auto insurance takes massive effort with very low generational impact. Now, the top right. Setting up LLQP private policies requires high effort upfront, but secures lifelong protection. Shifting your focus away from short-term frustrations and toward building a private financial fortress is the first step to actually thriving in Canada. Let's look at provincial healthcare. OHIP is great for basic doctor visits and emergency hospital stays, but it is not a comprehensive safety net. This split-screen scorecard compares expectations against reality. OHIP leaves massive financial gaps. It does not pay for prescription drugs, private nursing, out-of-province care, or the income you lose when you can't work. Consider the case of Raza, a recent immigrant. He suffered a medical crisis that required daily dialysis. He was completely unable to work. Without private coverage, the provincial system only kept him alive. It didn't pay his rent. His family had to crowdfund $25,000 online just to survive the years-long wait for a transplant. You mitigate this exact risk by securing living benefits, specifically critical illness and disability insurance. This matrix compares OHIP directly against living benefits. Critical illness insurance provides a tax-free lump sum, while disability insurance replaces your monthly income. Both pay out while you are alive and recovering. Look at the columns. OHIP checks the box for the doctor, but critical illness and disability insurance cover the rest, replacing your lost income, funding private care, and making sure your mortgage gets paid. Securing these living benefits guarantees that a severe diagnosis won't force you to drain your life savings or sell your home to pay for recovery. The next major milestone is buying your first Canadian home, and with that mortgage comes another critical decision. When you sign your mortgage, the lending institution will heavily push their own mortgage life insurance. They position it as a mandatory or highly recommended add-on. This line graph illustrates exactly how bank mortgage insurance operates. The bank owns the policy, and if you die, the payout goes straight to DEN. And as you pay down your debt, the death benefit, the amount of coverage you actually have, shrinks. The optimized alternative is a personally owned term life insurance policy set up through a licensed advisor. Watch the top line. With personal term life, your premiums are locked in. The payout stays completely flat, and the cash goes directly to your family, not the lender. Plus, you keep the coverage even if you switch banks. For some families, insurance choices are what decide their ability to remain in the country. Take the case of Samuel, a newcomer whose permanent residency application was tied to his employment. Because he lacked a portable personal term policy, his sudden death canceled the PR application. His family was left without status, without work authorization, and without access to the government benefits they were counting on. A personal term life policy places a firewall between your family's financial survival and external institutions. It ensures that neither a bank nor an employer controls your family's future. Once the breadwinner is protected, the focus moves to securing the next generation. Most newcomers are told that the Registered Education Savings Plan, or RESP, is the only tool they need for their children. RESPs do offer two clear benefits: a 20% government match on your contributions, and tax-deferred growth. But this flowchart traces the strict rigidity of that money. If your child takes the green path to a qualifying university, the funds work perfectly. But if they take an alternative path, say starting a business or buying a home, the government takes back the grants and hits your growth with a 20% tax penalty. RESP funds are also typically tied to mutual funds. A sudden, poorly timed stock market drop right before tuition is due can wipe out years of savings. Capturing free government money is useful, but the strict rules and market exposure make the RESP too rigid to serve as your family's only wealth-building tool. Instead of relying solely on the government, you can use a participating whole-life child plan as a stable, highly flexible alternative. This comparison matrix highlights the differences. A child plan builds a guaranteed, tax-free cash asset. Your child can use that money for any life event, with zero restrictions. The most effective approach is a hybrid strategy. You combine the best of both tools, contributing just enough to an RESP for the match and channeling the rest into the child plan. By doing this, you provide your child with an accessible pool of capital for adulthood while locking in lifelong insurance eligibility regardless of future health. This approach maximizes the free government grants while building a private asset that outlasts a single university degree. Trying to navigate all these acronyms, LLQP, CI, DI, RESPs, can easily cause analysis paralysis, but delaying these decisions only saves you a few hours of paperwork today. If a crisis hits tomorrow, that delay can lead to generational poverty. This 3-step roadmap is the newcomer blueprint. Step 1 is securing term life and critical illness insurance. This protects your current income and maintains stability for your immigration status. Step 2 is establishing a basic RESP, functioning purely to capture those free government matching funds. And Step 3 completes the map, launching a whole-life child plan for unrestricted wealth. You don't have to guess how to structure this. You need to partner with specialized experts who understand your structural transition as an immigrant. VeVaCI.ca is the premier destination for professionals and business owners in Toronto and Markham seeking these advanced strategies. Click the link below to request a strategic consultation, upgrade your financial mindset, and secure the foundation of your new life in Canada.